We're going to take a look at Cyprus, gold stuck in a trading range, and more coming up on For Pete's Sake. Hey Peter, how's it going?
It's going well, thank you.
So Peter, the dust has settled a little bit on Cyprus this week. Last week you did mention there was a psychological effect from the news that came out. What effect has this had on gold this week?
Well, earlier in the week, Cyprus, in my opinion, created a precedent. And the concern, I think, in the euro right now is this a precedent for future action should financial institutions get into trouble in some of the weaker economies such as Portugal, Spain, and Italy? And I think it sent a shockwave to investors that hold assets over the insured limits. And I think it will create some concern and some reflection, and I wouldn't be surprised if some of the more wealthy investors in Europe start to diversify their assets out of the EU market and move some of those assets into potentially Hong Kong and Canada, which would be my pick.
Now, in your daily morning Kitco note, you mentioned that it felt like Groundhog Day, that we have the same range going on and on throughout the week. What's your take on it?
Well, you've got the market is looking for direction. The fear factor of Cyprus last week and coming into early this week, yesterday, pushed gold from the 1588 up to the 1610 level. Wasn't able to push through there overnight again, and we now have it under 1600. So it's a yin-yang approach. There's enough fear out in the market to create a bid at lower levels. But some of the economic news, the durable good orders that came out today in the United States were much better than expected. So there is this feeling that the U.S. is going to recover, or is at least on the road to recovery, and will be a much stronger place to invest over the next 2 years than the eurozone. So there is some perception in the foreign exchange markets that the euro, with bounces in between, will generally weaken, and a stronger dollar creates a negative sentiment for gold. So you have two issues converging: the fear in Europe and the stronger U.S. economy, and the much stronger U.S. equity market, where funds continue to flow. And as long as that equity market doesn't get slapped, it's going to put some downward bias on the metals.
Now, with the debt ceiling talks off the table until August, September, what else might be in the news that could move gold upwards or downwards?
Well, the headline news. You keep watching the unemployment numbers, the housing starts, anything to indicate that the economy is accelerating, which will put some negative bias on the metals as people perceive that the Fed will take their foot off the gas. I think we're coming into a rough patch of economic numbers with the sequester. I think it's going to affect unemployment over the next couple of months. So I think that psychology is going to be muted. So what I'm looking for then is capital flows. And if the dollar continues to appreciate, that will be price negative for the metals. And if any headline news come out of Europe, that'll be price positive. In the interim, we're in a range, and it's boring. I think my blog this morning said Groundhog Day. 1588 seems to be, I wouldn't say significant, but at relatively good support in the short term, with 1610 still the upside target. Until it breaks through those levels, as a trader, I just stand aside. For long-term investors or investors that have a portion of their portfolio in metals, this is absolutely not the time to abandon that philosophy. We noticed just a little Cyprus issue. We're talking a rock in the Mediterranean, but the psychology of what they tried to do pushed the metals up significantly. So there is a lot of issues in the world. Add North Korea, add Syria, add Iran, that would create a prudent outlook to keep a percentage of your portfolio in metals. This is not the time to sell all your metals and think the world is a rosy place to be.
Now, when we spoke earlier, you had told me that you do see the market breaking either upwards or downwards. Whichever way it would be a big break. Do you see that coming up anytime soon?
Markets, I mean, since I've been in this business since the 70s, markets do not like ranges. The traders are going to try to push. One of these times they're going to become successful. They're going to either push that 1610 resistance or the 1588 support. If they can get through that support at 1588, just on an overall basis, assuming no major headlines coming out of Europe, and again, no geopolitical issues coming out of Iran and North Korea, if they can push through 1588, I think the 1527 level of last year is certainly attainable. Especially now, we're only in spring, I realize that, but as we get closer to summer, the volumes are going to start to dry up and the markets will become much thinner. So moving through ranges is going to become much easier with reduced volume in the market. I'd like to see the 1610 on the upside taken out. I still think the general economic climate, the monetary easing, the potential for inflation makes a case that metals will continue higher after this consolidation phase. But in the short term, my sense is the risk is to the downside.
Excellent, Peter. Thank you for joining me today.
You're welcome.
And thank you for watching this edition of For Pete's Sake. If you have any questions or comments, don't hesitate to send them to newsfeedback@kitco.com. Have a good one.